In today's video, we are going to take a look at a case study. We've got an individual in his early 60s who's got a lump sum of money presently positioned in the stock market, and he wants to get that money out of the market and move it into a whole life insurance policy for two main reasons, which we will go through in this video. So to provide a little bit of information on the case study, we've got a male, 62 years old, $500,000 in the market. And what he's looking to do is move that into a whole life insurance policy for two primary reasons. Number one, safety. He's seen the market go up and down. He's at a stage in his life where he does not want to take on additional risk. He does have other assets in addition to the $500,000, but how he's looking at this lump sum is getting it somewhere safe. And that was his number one goal. He said, I want to put it somewhere where it's safe and I don't have to worry about the values going up and down. I want that safety. Number two is liquidity. So he does want to have access to the cash value for opportunities, as he is looking to purchase a business right now with some partners. So he does want to be able to tap into that cash value if an opportunity arises. Now, some additional information. He's got a pension that starts in about 4 years. His wife is presently working and will likely work for another couple years too. So why I mention that is because he's in a position right now where he does not really need access to that $500,000. And he's mentioned that a couple times. So if you're in a similar position to this, you say, okay, I've got some funds over here. I'd like to move it somewhere safe. I still want access to it, but I'd like to put it somewhere safe where I don't have to worry about the value going up and down. This is a similar situation. Now, again, does not need access to the $500,000 for a few years. And why I have mentioned that 3 or 4 times now is because his current thought is to get it into a policy, but he's considering vehicles that will restrict access to the $500,000 as it moves into a policy. So his current plan was to take that $500,000, place that into 1-year CDs, and then every year take a portion of the $500,000, move it into a life insurance policy until the $500,000 is depleted. Why he's considering a CD is because he earns some interest, but the main reason, safe. Again, he wants to get it out of the market. So with that said, during the conversation, I did bring up this guy right here, premium deposit accounts. Some companies use annuities. What you can do, Mr. Prospect, if your current strategy, your current thought is to move that money into a CD, you could write a one-time check of $500,000 to the insurance company. They'll place it in a premium deposit account, or sometimes you'll see a single premium immediate annuity. This is a nice option if the funds are qualified, because then you can transfer it to an annuity. That transfer, there's no taxes upon the transfer, but as it comes out of the annuity, it is taxable. But my point is, you can move it with the insurance company, and then that account, the deposit account, will feed the life insurance policy every year. So if you want more of a hands-off approach where you don't have to think or worry about it, that is an option. However, here's the big thing to be aware of. You did mention that you might want access to the funds. If you put it in a premium deposit account or an annuity, while funds are in those accounts, you will have very limited access. If you want to access funds in a deposit account, there often are penalties associated with it. So anytime we consider these deposit accounts where I can park money and earn some interest from the insurance company, I want to be absolutely certain that I don't need or that I'm not going to want access to the funds there. Once they're in the life insurance policy, I can access them. But if you have a situation where you write that check for $500,000 to the insurance company, and in the first year you say, you know what, an opportunity just came up, I'd really like to access that, you're in a situation where the only way you can access it now is by eating the penalties, which we don't want to do. We want to avoid those kind of things at all costs. So with all that said, we did discuss that. However, as of right now, we're looking at not executing that option, but things could change. We've got time to decide on that. You can even start this after you start a policy, so you don't have to do it beforehand. So options regarding the product itself, funding 3 to 4 years. At his age, at age 62, The sweet spot is 4 years. You can swing it in 3 years. If he said, hey, I want to get the money into the policy faster, you can do that. But when you look at the exact same product, everything's identical except for option A, you fund $500,000 over 4 years, and option B, it's over 3 years. Option A will produce greater value on a non-guaranteed and guaranteed basis long term. So if your goal is to first maximize the cash value and then begin to use it, well, what funding period is going to maximize the value right out of the gates? The products we considered in his particular case, a MassMutual 10-pay, which is one of MassMutual's strongest options when it comes to cash accumulation, then a Guardian L95 with their 5% PUA fee, and the same L95, but with their 10% PUA fee. A couple differences here. The 10-pay product, based on the non-guarantees, will produce the most cash value and illustrate the highest internal rate of return. Based on the guaranteed values, it will be the lowest because it has a 2% guaranteed rate. But it is a strong option with a major mutual company that we've always seen deliver above the guaranteed values. Nice option there in that respect. Guardian L95 product with the 5% PUA fee. This will have the strongest upfront cash value and the earliest break-even point. Based on the guaranteed values, you'll see the highest cash value from start to finish. The same is true of the death benefit when we compare these three. The 10% PUA fee, however, will illustrate higher non-guaranteed cash value and death benefit figures. When we look at it long-term, usually it's after the 10th year, meaning when we compare these two, because we've got the exact same product, just a different PUA fee, for the first 10, based on the non-guaranteed values, first 10 years, 5% PUA fee is going to have more. From the 11th year onward, 10% PUA fee will have more. Looking at the guarantees though, 5% is going to have more from start to finish. So these are nice items to be aware of just as I compare and contrast different products if I'm trying to refine my decision-making process. This way I've got transparency and I can pick the option that I'm most comfortable with. One last thing, a difference with the options here would be flexibility, and this is all with money going in. We're not talking about loans here yet, as there are differences with the two companies and loans. But regarding flexibility, if he picks, let's say, a 4-year option and funds it at $125,000 per year for 4 years, that'll come out to $500K total. What happens here? Well, $125,000 per year for 4 years. With Guardian, he can get away with committing just to the minimum premium. Be that in the term rider, so I'm just going to round off here, say it's $15K per year. He can commit to that and then add additional funds to PUAs 100% at his leisure. So he did ask when we were on a Zoom call, he said, hey, that 500 going in or the 125 every year, I'm committed to that if I go with this option, right? No, actually you're not. If life happens, if you decide to dedicate some of that money elsewhere, say for your business, you've got an opportunity that pops up, and then you don't have the means to move it into your policy, well, you could easily pay just the minimum, and then you can add additional funds to PUAs at your leisure. It could be that year, or it could be 5 or 10 years later. It doesn't really matter. My point is, it's very flexible there. Mass is also flexible, but not quite as flexible. If you're doing things right, you can easily make payment adjustments 1 time per year on your premium due date. So when the minimum premium is due, that's when you can scale your PUA payment up and down as well. A lot of technical stuff, but those are good items to hit on just so we know what's available with different companies and products. Let's take a look here. So what we'll begin with is the L95 policy with a 10% PUA fee. And in fact, let's hit on that flexibility piece because sometimes people do have questions here. Like when I talk about being able to commit to the minimum and then add more at leisure, what does that exactly mean? Well, if this is your policy, you go with this option, your premium is up here. Now, we also have this term rider down here, the term rider cost. The actual term amount is up here. Purpose of term, cost-effective way to raise the death benefit, which raises what? That MEC limit on a policy to prevent a taxable event from occurring. So looking at this, here's your minimum commitment. Usually individuals we work with that choose Guardian as far as the company they want to move forward with, in most cases, they'll set the policy up in a manner where they are only billed for the minimum. So that means they're billed for the base plus the term. Sometimes we'll round up, maybe it's $15K. If we round up, everything above the premium and term rider does go into PUAs. And then everything else can be added on an unscheduled basis, meaning they add funded to PUAs literally whenever they want. So looking at this guy, we've got a total of $500,000 going into the policy over 4 payments. His question was this: hey, if I don't make a payment of $125, say I've got the funds, I put them in 1-year CDs, but an opportunity comes up and I want to use the funds once I cash out the CD for the opportunity instead of the policy just because I need the liquidity right now. What happens to the policy? Well, the answer was this: you could easily pay just the scheduled minimum, and we would illustrate this too so we would see what it looks like, $15,000. And then over the course of the year, you could add the rest of it. If you don't, say next year you do 125, but then you keep going. Maybe when your pension kicks in, you decide to move some of the funds into the policy. If you said, hey, I don't need it and I'd like to continue to add money to this policy to beef up the values, both the cash value and the death benefit, because this is paid income tax free. So from an estate planning standpoint, that can work out well. Income tax free, however, not estate tax free. Death benefit proceeds or not, that's where you do need to look at trust planning. Back to that Excel workbook, which just looks at a side-by-side form. So we've got the L95 5% PUA fee. There we go. What's highlighted in yellow represents his break-even point, which is when his cash value is equal to his total payments. When does it hit? Just about year 4. That kind of stuff just, I don't want to say annoys me, but I'm kind of like, so close. Maybe we should bump up the health rating to get it. No, we don't want to do that. If he gets ultra preferred, then he'll be right at that year 4 mark with this particular product, or very, very close. But there we go. No payments after year 5 with the option to do so. Let's take a look at something else here. We've got our annual internal rate of return and also the total gain. So this is very, very valuable if you're looking at your policy and trying to figure out what is it growing by. These are samples with Guardian, that illustration we just had up. You know what Guardian's dividend rate is for 2023? You might. It's 5.75%. Does that mean that your cash value is going to grow by 5.75%? My answer is I wish. However, that's not the case at all. So when I look at a dividend rate, always keep in mind that that is a gross rate applied to the policy after the insurance expenses and such. The annual internal rate of return shows what the policy is growing by net year over year. So looking at this, year 1, I pay in 125. I've got 109 and change. I don't care if the dividend rate is 575%. If I've got 109 after I've paid 125, there's my IRR, negative 12.6%. Now, to be fair, we are getting a $1.4 million death benefit too. So there's costs associated with the product. We're minimizing them as much as we can, which we always do when cash value is the goal. But at the same time, even with them minimized, we've got the cost of the death benefit there, which is why I've got that hit up front. Year 2, he pays in 125. Why we see an IRR of about 0.5% is because he gets his 125 back and a little bit more on top of it. Then each year it'll get stronger and stronger. The total gain represents total payments and how much more or less you have in cash value than the total dollar amount you've paid into the product. So here, you've paid in $500,000. By year 4, you're at $499 and change. If I look at it at age 80, you've got a $358,000 gain based on the non-guaranteed values with this particular product. Things will change over time. That's where it's beneficial to track the actual performance. Then we've got the 10% PUA fee. Same product, higher PUA fee. What do you notice here? Look at the first 10 years. Which one has more? 5% PUA fee. Year 10, look at the line. What's the difference there? On the total gain, there's like nothing. They're almost neck and neck. Right? Literally, it's what, $11, $12? Not much at all. So, first 10 years, you've got more with the 5% PUA fee. From this point forward, you've got more with the 10%. Again, if I'm working with you in a case like this, or if you're working with us, we are going to look at the guarantees here too. Just because the last thing I want to see is, hey, I like the long-term option here, so I'm going to go with a 10% option, and then 3 years later, you see the guaranteed values, like, wait a minute, this has stronger guarantees. I would have went with that. Seeing them up front allows us to pick the one that we prefer, let alone what the agent prefers. The agent being me in this particular case. All right. And then we've got the MassMutual 10-pay product. Looking good. Strong upfront cash value. Year 2, 3, 4, 5, just about there, $4.99 and change. So you can see the break-even points here. The 10% PUA fee and the 10-pay are both right at year 5, whereas that 5% PUA fee is right at year 4. So if I like more upfront and stronger guarantees, fantastic option. If I like more long-term potential, one of these two are fantastic. Maybe I like MassMutual, being a behemoth of a company. A lot of people are comfortable with them. And when I look at the potential here, based on where dividends are right now, this is a very attractive option. So that's a quick sample. There is more information we can go through when we go through the illustrations and such. Of course, it depends on what specific questions the individual has. The last thing we would look at here is the difference between a 3-pay and 4-pay scenario. So we'll actually look at this guy, the 10% PUA fee. And what do you notice here? This is based on the non-guaranteed values. 4 years to the left, 3 years to the right. What that means: you fund a total of $500,000. In option A, you do it over 4 years. In option B, you do it over 3 years. Which one is more efficient? First 4 years, you've got the 3-pay. What about after that? It's the four-year option. I don't know why that's the case. A lot of times people ask that, especially, remember years ago, an older gentleman had a lump sum. He was considering between $800,000 and $1 million he wanted to pay into a life insurance policy. He was looking at MassMutual that year, and the dividend rate was 7.1%. You know how long ago it was now. It was quite some time ago. But his question was, hey, if I just write a check for, call it $1 million, and I put that into a whole life insurance policy, if it's earning a 7.1% dividend, shouldn't that produce me the highest overall value? Because it gets into the policy and starts earning interest right away? And the answer is no. Why it's no is because year 2, we still have that premium that's due. And if your intent is not to pay it, it's got to be paid from somewhere, which if we're not paying it, it's got to be paid from the premium, either through dividends and interest or through an automatic premium loan, which typically is not a good idea if we don't plan on making payments again in the future. So here we go, just to illustrate this, and we'll wrap up with this. This is the 3-pay option. Here's your funding, $170 in the first year and $165 years 2 and 3. Where's your premium? Up here at $15,000. So years 1, 2, and 3, there's your out-of-pocket, meaning you're paying the base premium, and then everything else covers the term rider first and then goes right into PUAs. So you're covering the base premium with your cash in the first 3 years. Year 4, premium is still due. It's due through year 7. So you've got 4 years where you are not paying it. So what's happening here, your out-of-pocket is 0. The policy is paying for the premium through dividends and the guaranteed interest. So this dividend column excludes the guaranteed interest rate. It's the surplus only, which with this product would be 2.75%. We've got other videos that go through that. But the policy is covering that. And the cash value is still appreciating, which is good. There we go. But through year 7, I refer to that as drag, meaning it has to cover those expenses internally. So If we look at a 4-year funding scenario, we have 1 year less where the policy has to pay for itself, and we also have a lower premium. So now when it begins to pay for itself, there's less drag there. Here we go. And there's always a sweet spot here too, because if we spread it out over 5 years, then you would actually see that the 4-year funding scenario is more effective, so more efficient. So do I get money in quickly, and how quickly can that get to work for me versus spreading it out and covering the expenses? It's somewhat of a balancing act, but generally it's going to fall somewhere between 3 to 5 years. Your age and health does have an impact on that. That's going to be the biggest factor we're going to look at. But in this case, early 60s, I would go 4 years. If he had some health issues, I got a standard non-smoker rating, I might look at 5 years. But those are the kind of things we want to look at. In any event, I hope that you enjoyed this video. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.